I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. I interview all sorts of people on this podcast, but today's guest is a candidate for one of the most exceptional entrepreneurs to have come on the programme to date. Most people have the talent. A lot of people have the instincts and the drive, but few can combine that with the breadth of knowledge and ability to connect up the insurance value chain all the way from a homeowner right up to the most sophisticated capital markets. Today's guest, Terry McLean, combines all three attributes, and the results speak for themselves. His MGA group, SageSure, is likely to be writing $3.6 to $3.7 billion in gross premiums in 2026, almost all of which is sourced from the cat-exposed segment of the US homeowners market. Terry embodies the pioneering spirit, in that when others are walking away from a risk, his first thought is to walk towards it, because that's where margin is likely to be found. And in a class like US homeowners that seems doomed to produce negative aggregate returns year in, year out, margin is a very precious commodity indeed. So I would add a fourth quality to the list: bravery. Terry's got it in abundance. So listen on for a remarkable story with an exceptional insurance entrepreneur. I guarantee that even if you are feeling your most jaded, you will finish this podcast with a smile on your face and a spring in your step. Enjoy the podcast.
Terry, welcome to the Voice of Insurance.
It's great to be here, Mark. Thanks for having me.
Anybody out there who doesn't know you, Terry, why don't you just briefly introduce yourself and run us through your career to date and tell us how you got into insurance?
Happy to do that. So when people ask me, Terry, tell us about yourself, the first thing I say is I'm a runner. I grew up a runner. I've raced my whole life, went to college to run. That won't be the topic of the podcast, but I'm a runner. That's how I think of myself. I grew up in Cincinnati. I went to high school and I thought I was going to be an actuary. Thought I was going to be a pensions actuary. My dad was a journalist for the National Underwriter Company for 30 years. And I loved math. I mean, I liked science. I was good at science, but I didn't really love science. I thought I was going to be in something where I was going to use finance and actuarial science and math in a financial context. And I was like, well, insurance seems like the most interesting place to do that. I think I was actually right about the insurance part, but pension actuary, not so much. But I did go to university. I studied at University of Pennsylvania. I studied actuarial science. I studied finance and I studied computer science. Came out of school. I passed 6 actuarial exams on the Society of Actuary side. And I thought I was going to be on annuities and pension actuary. Then I did that for a year in Cincinnati and decided that wasn't going to be for me. And I moved to New York and did insurance mergers and acquisitions for UBS and DLJ as an analyst there, and loved that. Great learning ground, great people, but also figured that wasn't going to be my career. And I meandered around. I stayed at the investment bank at DLJ for a little bit, learned a lot more about technology, oversaw some technology operations. And then I stumbled into this insurance company, played golf with a client of my brother's. My brother was a commercial lender, and a guy named Chip Van Meter was one of his clients. And Chip owned an insurance company. He was a majority owner of an insurance company called American Superior Insurance Company. Started as a Depop in 1997. And Chip needed help. They needed some help cleaning up this insurance company. So I went down to Florida. I said, Chip, sure, man, this is a mess. And he said, can you help? I was like, yeah, probably, but I'm not going to do this long term. Anyway, so I went there for a couple of years, built some technology, brought some people in, cleaned up the company, got it back to profitability by the end of 2003, and left there and had met some people from Renaissance Re, went to work for Ren Re for a year. And then when I was at American Superior, I met a guy named Andy DiLoretto. And Andy is still a very good friend today. He's not active in the business anymore, but Andy called me. I still remember I was at LaGuardia. I was landing in LaGuardia. I was on a plane, I think from Bermuda maybe. And he was landing in LaGuardia and we met in the airport. And he said, let's start something. And so that was 2005. And we had 2004 hurricanes, 2005 hurricanes. And the idea
was after the hurricanes, yeah?
Yeah. And the idea was, let's go start something that capitalizes on the retreat of the large national players away from the coastline. So they had Andrew and knocked them away. And certainly people started retreating from the coast, and you had Florida Depop companies, but the trend wasn't that pervasive outside of Florida. But after 2004, 2005, it seemed like, okay, this is going to be a permanent retreat from the coast. We're going to have a fundamental change in property insurance. So I think we had the right thesis there, but the wrong business plan. So we started a software and services company called Insight. And while I think we had the right idea in the right direction, selling against big reinsurance brokers and other people who are, they're getting reinsurance brokerage and their advisors selling software against them, at least in that time, was pretty tough. And so it didn't take us too long to figure out the best way to monetize this business was going to be to start an MGA, MGU type of operation. And so we dabbled, we got Berkshire paper for 4 policies or something. It wasn't much to be spoken of, but we had built out our technology and our software and services business to be able to launch the business. And eventually, after years of working and talking to people, I mean, it was tough to get paper. And eventually, we both were friends with a guy named Dave Perung, and Dave gave us a shot. He works at IAT still, the CFO and the president of the insurance companies at IAT. And Dave gave us a shot and he said, yeah, we'll give you some capacity. Go show us what you can do. Rod Fox had connected me with a gentleman named Brooks Clark, who joined us in 2008 as a partner. And ultimately, we launched our first product and wrote our first policy in September 2009. That was the journey. That was the beginning. And we knew we were going to lose money in the process of getting this thing stood up. There weren't, I don't think, as many people doing it there with every intention of building a full stack without the balance sheets. You know, you had distributors, MGAs, I'd say more traditional MGAs that had bad reputations. And I mean, maybe some people still think they do. I don't think they have as bad a reputation as they did back then. Mostly they were churning and burning people and they would move books of business around. We had no intent to run a business like that. We were thinking of it more like an MGU operation where we differentiated based on underwriting, we differentiated based on risk selection, did our own pricing, and ultimately get additional capacity sources. But IAT gave us a shot. They allowed us to grow to a couple $100 million before we really needed to get additional paper. So it was just fortunate to have such a great partnership with them. They've been great partners, still great partners, going on a trip with them next week. So love those guys and really appreciate the partnership we've had with them since the beginning. But yeah, that was the beginning and how we got into the business.
That's amazing. I mean, it must have been one of the first Depop, for anyone who doesn't know, is somebody taking policies out of Citizens, the state-backed insurer of last resort in Florida, which, of course, there wouldn't have been that many Depops at the time when you first did that. And, of course, it's funny you saying, we hadn't really made it, but we got paper from Berkshire Hathaway. So that's not bad. That's usually the last paper you get, not the very first paper. It's pretty good credentials already, Terry. They're kind of speaking for themselves. So that idea for SageSure, I remember that time. I remember every time I spoke to a London underwriter in the post KRW, that 2006 underwriting year, very particularly, coast is toast. That's what every property underwriter.
I haven't heard that one. That's a good one.
Well, yeah, it was. It was kind of soggy toast, obviously, if it's too near the coast. So yeah, those specialist underwriters were moving away from the coast, and obviously you were moving selectively towards the coast thing. Well, I suppose if there's a general retreat, obviously you could tell that not every building was built to the same standard, of course. And, buildings are built all the time, and some are really old and some are pretty good and some are pretty hurricane and flood resistant, one presumes. Was that your main premise, that you could cherry pick, or did you feel like we can do this? We can really do this?
Cherry pick is, I think, a pretty loaded term. Certainly the mindset.
I mean, just you'd have the opportunity in a less competitive market, effectively, if everyone else is on a very generalized basis moving away from something. If you move towards it, you get a really great showing. You get to pick what you want to underwrite, and then you can decline what you don't.
Yeah, I think there's really 2 parts to that. So there's the one part of, in a hardening market, sure, it's not that difficult to pick the best. Ours is, I think, a much more long-term thinking mindset to the business, which is the preferred customers have historically been disadvantaged in the marketplace. In other words, the best customers have been subsidizing the worst side of the customers. I think this is pervasive in a lot of lines of business, but having my expertise on the homeowner side is absolutely true. That the best customers were overpaying and they didn't deserve to pay as much as they were paying in the lower end of the spectrum. And I think many of the large nationals, just going after market share, weren't differentiating enough between the best and worst customers. The number one predictor of loss of homeowner frequency is insurance score. That's just the way it is. We don't have anything better. Maybe something better will come along at some point, but it's the number one predictor of loss frequency on the attritional side. And it's a pretty decent predictor of loss more generally on the hurricane catastrophe side, depending on the size of the event. And we knew this, and we intended to say, it's not really going to be that hard going to independent agents, going to partners who wanted capacity, distribution partners, and saying, go sell this to your best customers. Most of our distributors knew that they wanted to get the best customers, and in some cases had a lot of the best customers, and they needed product in coastal areas. So our view wasn't like a fly by night, it's a hard market, let's go get the cream of the best customers by itself and write it on a E&S property form. Ours was, these are going to be admitted markets. Customers need insurance. 95% of insurance is sold admitted. That isn't going to fundamentally change. And let's go build a long-term business strategy to underwrite these risks, inspect 100% of them, make sure we know what we have, and keep loss frequency low and loss severity low, and give those preferred customers a product that is going to outshine from a price perspective while we can make money for our carriers. And I think that's the hard thing about this business is anybody can go grow and sell and put a price on something and theoretically build a successful insurance business. The hard part is doing that and making money for your carriers. And historically, everybody in the MGU space, and certainly in 2009, when we began this, there were no examples, zero, of people who have done that as a homeowner's intermediary and made money for their carriers. Now, in most parts, the carriers weren't going to give them paper anyway, so they weren't really responsible for the underwriting profitability of the business. And so we set apart to say, we're going to make this look like a balance sheet, somebody who's really concerned about the underwriting profitability, but we're going to bring product to market that is price competitive for a subset of the customers. So that's how we approach the business. It didn't have to be post 2004, 2005 to make our business model work. We believe there was a permanent retreat of the big nationals. Who's going to fill that void? On the E&S side, really, we weren't too concerned about that. But on the preferred customer side, the people who are going to mostly stay in the admitted market, our view was there's a huge opportunity in the tens of millions of dollars across the coastline from New York down to Texas to find those customers and bring them a competitive price point for their agents who need the capacity. So that was the mindset.
Yeah. So the ideal customer, how would you describe them? A homeowner of some description?
The simple way to describe it is somebody who's in a new house or a house with a new roof, a newer roof. And you know, you can have decent 10-year-old roofs and they can be fine. And we'll write those customers, but certainly our bias, I haven't looked at the stat and I don't think in the last year, but last time I looked, I think our average age of roof was 7 years. And so, you know, across the spectrum, that's relatively new. You know, 7 years in New York is a lot better than 7 years in Texas, given sun baking and anyway. So there's a lot of complexity there. It's a customer that on average is better. We'll write customer with any insurance score. We don't decline anything based on insurance score, but the customer profile target is going to be a customer on average that has a better than average insurance score and somebody that has a clean loss history. Those are the three biggest factors that are driving. It's the age of the roof, the insurance score, and the claims history. Now, of course, there are dozens of very important other factors, and there are hundreds of other factors that get taken into account. But those are the most notable, easy to understand ones. I mean, while we don't target low value and we don't target high value, we'll go pretty far across the spectrum. That for us isn't a major determiner of what we will and won't do. We won't do the $20 million coverage A. We won't do that, but we will go up to $5 million on coverage A. We're not competing with the Chubbs of the world, but we are willing to write the houses that happen to be larger or in more expensive to rebuild areas, and they're fairly homogeneous. We aren't going to be the fine art underwriters in doing the collections sort of stuff. That's not our game.
Or too many people have a kind of very expensive looking boat sitting in their driveway, or they always end up in their driveway, even if they were actually parked in the, you know, the private mooring out the back. But every time I look at them, of course, as an insurance journalist, we only come after the event and we see them all. They're always down Main Street.
Yeah.
And for anybody who doesn't know an insurance score in this sense, this is a generalized underwriting tool that you use over in the States.
The official term is credit-based insurance score. So
it's a form of credit rating. mostly?
It's a form of credit rating that has been actuarially proven to be correlated with the loss history of the customer. So there's three major credit bureaus in the United States: Experian, Equifax, and TransUnion. We have worked with TransUnion for years, really since inception. I don't honestly know how to line them up and say what's better than worse, but we chose TransUnion. And they do the work and file it with the regulators. And of course, we file it. How we map their filing with the regulators to our product is proprietary, and filed proprietary is confidential information with the regulator. So we leverage their model that's off the shelf and call it accessible to the industry, and then customize it how we apply it to our individual business.
So what sort of scale have you managed to get to? Obviously, you started in Florida only. How many states? I mean, you're Texas to Maine, would that be right? And other states as well?
We started in New York.
You started in New York?
First policy was in New York in 2009. Our second state was Alabama. Our third state was South Carolina. Our fourth state was Louisiana. Today, our largest single state in premium is Texas. I think we'll approach 800 or 900 million in Texas in 2026. With the Olympus acquisition, we'll be 700 million in Florida. So call it, we were about 200 million in Florida before the Olympus acquisition, and bringing their Florida only about 500 million there. Louisiana was our second largest state before the Olympus acquisition, about $500 million there. New York, again, pre-Olympus was number 3, now number 4, with about 400 million in New York. And then California, South Carolina round out the top 5.
So what's that adding up to?
So with pro forma for Olympus, we're at 3.2 billion of premium across all our states in 2025. We expect to be in the 3.6 to 3.7 billion range in 2026.
Wow, that's really impressive. So how do you want to be perceived in the marketplace? Do you still want to have that element of property cat exposed homeowners? Is that the way we should always think of you? Will that develop?
Yeah, I think that's fair. I don't have any problem being thought of that way, or think that's something that we would think of ourselves any differently, frankly. It's not our only game. It's not the only reason we succeed. Cat exposure. The interesting thing about why we've chosen that, and why we're, I'm certainly okay with that label, is the business historically in the US, and frankly, I don't have a perspective of what this looks like internationally. But if you look at any 5-year, 10-year, 15-year, 20-year, 25 or 30-year period of the US homeowners industry, you will be at a 3 to 5% negative margin in any of those periods historically in the US homeowners industry. And we have the good fortune that this stuff is reported in yellow books by line. And since homeowners is broken out very specifically, we have the luxury of an immense amount of data available to us to look at that. The only thing we don't get is the alien insurers in the US, like Lloyd's, don't show up in those numbers. But outside of that, we have all that data readily available to us. And you can see it's a very ugly picture. We could spend the rest of the podcast talking about why do companies do that? I ask myself that question a lot, but they do. And so the industry has struggled. So our approach has always been go to where there's margin. And what's super interesting, I presented at a finance conference. I digress for 10 seconds about that presentation. I was the first presenter from the insurance industry. The person who put on the conference, Mr. Jim Grant, said I was the first insurance person that spoke at that conference in 40 years. Somebody from Travelers did it in 1985, as he told me. And what I spoke about, and he felt the need to explain to a finance crowd, is how kind of insane looking the US homeowners industry looks from the outsider's perspective, that insurance companies don't make money. And one would ask, where do all the profits go? And I explained, all the profits go to the reinsurers. Now, do the reinsurers deserve that or not? I think they do, because they're taking most of the volatility. And where is the volatility coming from? It's coming from catastrophe exposure. So that origin, why we're in the catastrophe exposed property businesses, it's the only place where there's any real margin. And if you manage it properly and you think about what we do and focus on, we focus on catastrophe exposure, not just as underwriters and pricers, but as risk managers. So we have to think about it and say, how can we go into this business? You can't over concentrate in one area. That has perverse impacts on reinsurance costs and so on, which I could spend a lot of time on as well. But ultimately, the cat exposed property business has enough margin that managed properly and against the right customers at the right price, you actually have an opportunity to make money. And so it's not all about the profits for us, but we need to make money for our carriers. And so having a tailwind, no pun intended, in the business line of profitability, or at least having margin in the business, is, in our view, necessary to do something. So we would love to be a homeowner specialist in Ohio if we thought, I'm from Ohio, so I always pick that state. And it's a large state, but the margins in it are negative almost every year. And so it doesn't present itself as a place that's attractive to go into. So we don't have ambitions to go to 50 states unless there's an opportunity where we say the market is dislocated and we think there's a sustainable way to go make underwriting profits. And I do think there are, and we certainly have some hypotheses on ways that we may do that over the long term in the way distribution changes over time and so on. But really, we found the cat exposed property space is a space that, for very logical reasons, lots of people stay away from, where we can have a sustainable competitive advantage, not against everybody, but against enough competitors that there's a place in the market for us to continue to thrive and to continue to grow. So yes, short answer is, I think it's a fair way to characterize us. And it's fair to say that we are happy playing in that space and think we have a long runway to grow in that space.
I suppose over many years, if you were an insurance company, you'd be therefore described by many in the investment community as a monoline cat insurer. Obviously, that, within the insurance world is not flavor of the month. And that stopped being flavor of the month. And RenRe probably was an example, was effectively a monoline Bermuda cat reinsurer, of which there was a whole class from, post Andrew, et cetera. And, obviously RenRe was formed in that sphere. And then by the late 2000s, certainly by 2010, that was really not where investors wanted you to be. And those Bermuda monoline cat reinsurers slowly disappeared or diversified. But with you, do you feel you've got enough diversification within the fact that you're in enough states that are mutually exclusive places to a great degree? Obviously, Texas is definitely mutually exclusive from New York in terms of wind, isn't it? So should we expect you to be diversifying more and perhaps even internationally? And also, it sounds like you can't diversify to all of the states because you only go to states where you feel you can get the margin.
Yeah, it's a great question, and certainly something we think about a lot. So if you look at the size of the space that we're in, and we started in homeowners, and of course, for those that don't know the US as well, we have homeowners, owner-occupied structures, but we also have tenant-occupied. So we've always been in the dwelling space as well, where tenant-occupied homeowners. We've gotten in commercial, and in 2025, we passed $100 million. $100 million is a pretty good-sized business, and we have that commercial property business that is thriving and growing, operating in the same geographic footprint. So we've diversified in that manner. We're not going to be writing the large commercial structures, layered and shared stuff, but we will continue to write commercial property and expand in that space. Flood is an area of, I would call, expansion, where the market's expanding at an outsized rate. And we find it very interesting and sort of part of our core mission to be a larger part of, something that we haven't done very much of historically. We've gotten more into California. We were very small in California for a number of years, and wildfire needs have grown tremendously in California. We got into the quake space with the GeoVera acquisition. Yeah. So we've diversified perils, gotten larger in certain states, diversified lines of business. And we're still all talking US cat exposed property. So there's a lot of running room here. That said, I'm 52 years old. I probably have a few decades left on me. I love what I'm doing. I have a lot of passion for this. So certainly in some time frame, you start saying, well, what else is there? Is it geographic in the US? Certainly thought about that and how you would do that. We're open-minded to that if it makes sense. Right now, I continue to believe it doesn't make a lot of sense. Maybe a few states here and there, but not thinking that 35 or 40 or 45 states comes anytime soon. But, having done 2 acquisitions over the past 2 years, you could really see that can transform a business and create opportunities we don't have. So I wouldn't be surprised, got nothing in the hopper right now in that regard, but it could change things at some point if the right value opportunity pops up. And you asked the question internationally. I would love to think about that. The truth is, I have grown this business and have always thought about things that are adjacent, where we have expertise that we bring to the table, and we don't have any international expertise. I think the entry into the Lloyd's market writing US business, and over time, becoming more part of international capital leads us down a pathway of maybe. Certainly isn't on our radar in the next year or two, but I could see ourselves 10 years from now. Would I be surprised if we're doing something internationally? I wouldn't be surprised.
Yeah.
So, but certainly not in the near term for us.
Yes, because you mentioned Lloyd's, you've become a Lloyd's cover holder, so congratulations on that. But that's not part of some wider strategic plan at the moment. That's just, well, you're accessing, obviously, a pool of capital. It's a very nice security for people to access and an interesting market, obviously, with all sorts of people who, yeah, I'm sure will be very pleased to know you. It sounds like generally you're happy that there's still plenty of runway for growth. You don't need to diversify in order to help you grow because you've got tons of space to grow within the states you're already in, right?
Yeah. By our estimates, the US cat exposed property, and this includes Midwest, Plain States, so it's a bit exaggerated, but it's about 200 billion. And then the parts that are what I'd call highly cat exposed is about 100 billion. And that's a pretty big number. And so while being a $3 or $4 billion player in that is notable, and we're somewhat proud of that, we're still a few percent market share player. I don't think we're ever going to be a 50% market share player. I don't think that would be healthy, but I don't see a reason why we can't be a 10% market share player in these marketplaces. And as they grow, we grow. And I think there's still a lot of opportunity.
What's your philosophy in terms of holding capital on your own balance sheet? Obviously, you've been running effectively a virtual insurance company, but just without the balance sheet. You've got a strong relationship with capital, with the ILS market, for example. What's your view on that? And obviously, in the last 5 to 6 years, we've had a real development of a hybrid carrier ecosystem as well. Where do you fit in with that?
Great question. Yeah, it's been an interesting journey for us. So SageSure is purely an MGU. SageSure does not have any balance sheets. My interest in SageSure sits in an entity called Slaine, Slaine Holdings. And a number of my business partners are at that level as well. And Slaine owns, I think it is 60-something% of SageSure. There's some minority investors outside, some great partners that own the rest of the minority. But Slaine controls SageSure. And Slaine has an interest in a few insurance businesses. For example, when we bought Olympus, the MGA went inside SageSure. It is a subsidiary of SageSure, and the insurance balance sheet went under a subsidiary of Slaine that's not SageSure called Valence. And Valence owns the insurance company. And we've created some reciprocals in that manner. And then we have some other investments that we've made in other balance sheet providers. So we have a very close, highly partnership-oriented mindset toward the business. We certainly, as we tell every reinsurer and cat bond investor, we put our money where our mouth is. So we have over $500 million of our capital invested in balance sheets in a non-controlling way. And so we have a lot of capital risk, a lot of skin in the game. Over 100 million of that is in captive reinsurance vehicles, where we're doing quota share, catastrophe excess of loss reinsurance behind insurance companies that SageSure writes on. So we have an interesting relationship with capital, one deeper, but in no way ever is it what I would refer to as a full stack, where we own the balance sheet, control it in the same together at the same time as the MGA. We have independence, and there's underwriting oversight committees at all of those balance sheets that are separate and independent. In some ways, you could think of it like the Fidelis split up model, where the MGU and MGA, they have a long-term relationship. They expect to be together, but they can do business with other people. And so we expect, for example, in the Giovera acquisition, we have a huge relationship with Giovera. We have hundreds of millions of premium with them, but they also do business with the likes of Amrisk and Arrowhead. And we expect them to do business with others over the long term. And there's nothing wrong with that. We're happy with that. And we have a healthy, balanced relationship where we have capital in and we have influence on the business that we're working with, but they have the balance sheet and we have to listen to them, and they have the ultimate say on what happens on the balance sheet. So that's our relationship. It's a complicated one. I would view a necessary one to do what we've done successfully.
Do you have an optimal view of what percentage of the underwriting of SageSure should have some of your own skin in that game? for example? Or is there an amount where it starts to become too much, or is there an amount where it becomes too little? I presume it must be very useful, particularly when the market's more difficult, to have that optionality, and also just always there to anyone that you are in negotiations with, provide paper for SageSure. They all know that you're sitting alongside them, and it's also your money. If they bleed, you bleed as well.
Absolutely. That is, in my mind, certainly with the global reinsurance market and catastrophe bond investors, one of the most important things you can say is that we are aligned and we have a lot of our capital at risk. You asked the question about a percentage. I don't know what the right percentage is. To me, it feels like somewhere below 50, but not much below 50 would be a happy place to be. We certainly don't mind being aligned, and ones to say we shouldn't have any skin in the game. We're quite happy to. And if we do our jobs, we're making money for our carriers. And so we're quite happy to have our money invested that way. But when it's the majority or the overwhelming majority, it has a few negatives like, well, other people are like, why would I go route business on a balance sheet that SageSure owns? We don't want to create a disincentive from the capacity providers from being effective markets for others. So I think it's somewhere in the middle there without being too small or being too large.
If you become too big, then they might see you as a competitor rather than a collaborator.
Exactly. That's right. And so in this cycle of the market right now, a lot of these balance sheets, we were the only source of capital in certain cases. And we are definitely going in a reduced risk posture, not to mean we're laying off 100% of our invested capital, but we are reducing our amount of capital and with an expectation to get closer to the 50% number I described. But right now, we're well above that. The exception is our relationship with IIT, but with others, we are definitely above that 50% number. And over time, it makes sense to begin de-risking.
And that relationship with ILS, again, that's not very common. That's a very sophisticated tool to be accessing from someone who's running an MGA, MGU. Is that something that's going to be increasing over time? Obviously, the ILS market is in a very strong position. Cat bond market's got record outstanding limit at the moment, and there's still plenty more to come, it seems.
Yes, it's been an interesting, exciting pathway for us going from very little in that space in the hardening market. It was the thing that allowed SageSure, while many others were retrenching, some companies were going bankrupt and struggling, we were very well positioned to grow. And the only way we could get the reinsurance capacity was the catastrophe bond market. And it really was there for us. We needed it. So we're very fond of the ILS market and what it did for us to enable our growth from around $1 billion to very quickly well over $2 billion during the hardest of hard markets that I've ever seen in my career. So we're very fond of the market, and we invested heavily in traveling around the globe to European cities, to New York, of course, Bermuda, and elsewhere to speak to those ILS investors. And so we got big pretty fast. We needed them, and I think they were quite happy with what we brought to the marketplace. We feel that we bring a rare story to an industry that has, certainly on the cat bond side, been dominated by the large players, the State Farms, the USAAs. If you look at the top 10 sponsors, there's a couple residual markets on there. You've got TWIA on there. You've got the California Earthquake Authority, pseudo residual market kind of mechanism. Of course, you see Florida Citizens. You see the USAA, State Farm, Allstate names on there. And then you see SageSure. What's SageSure doing here? And so we certainly are outsized percentage of the business that we do. And, maybe if you add up the numbers, we're probably across SageSure number 13 US homeowners insurer or something like that, if you compared it to the rest of the insurance balance sheets. So cat bonds are a bigger share, an outsized share. I expect it to be an outsized share for some time, but it's limited in how much the cat bond market really can do because they don't want to play in a lot of the places that traditional reinsurers will do, the rated balance sheets will do. So I suspect at this point, we're at a point of stability where we'll continue to do new cat bond issuance and we'll take advantage of that market. But I think we've hit, I don't know if I'd say the limit, but based on the way the cat bond market is structured today, we're pretty much at a percentage that appears to be stable from here.
Yeah, when the market really comes through for you, you become a very loyal customer at that point, don't you? What about the market itself? Obviously, we've just come through the 1/1 renewals. I spent a lot of time talking to all the analysts and the brokers with their reports, have been, compiling all the data. Everything's come in. Just in very broad terms, in property cat, someone was describing me to say, well, remember 2006, that great year, 2007, and then we gave a lot back. Well, we've given a lot back. We've probably given 2 years worth of rate reductions in 1 year, and we're back about where we were in 2008, 2009. One, would you agree with that? And two, we've got a 15% rate decrease at 1/1. So what does it mean for you?
I think the sentiment that I agree with most in that question is it does feel like we've got 2 years of rate reductions in one. It feels a little bit overdone. And most people in my shoes would be like, isn't this great? This is the way it should be. It feels a little overdone to me. I like stable markets rather than volatile markets. The rate movement down seems outsized. And so, that's the market, right? Supply and demand of capital. People want the risk. It feels like memories are too short in my mind. That's what worries me. The risk is real. We had a good couple years, but geez, it does feel like 2 years of rate reductions. What it means for our business is a lot of people were worried about an affordability crisis in places from Florida to Louisiana to Texas to California. And it's really good for the US consumer. This is going to avoid an affordability crisis in homeowners insurance, which is good because regulators, if they're responding to political pressure, sometimes do things that they really shouldn't do. And I do think there were some political pressures building. Certainly Florida, we saw how that played out in a very positive, healthy way in creating reforms. We've seen the Louisiana market. I mean, I thought very highly of Commissioner Donovan in Louisiana. I think very highly of the current commissioner in Louisiana in doing good stuff to create a healthy market and saying, look, we had some catastrophe activity. Prices need to go up. The market needs to find a happy place. We cannot put price controls in place and find a happy place. So those customers, there was a lot of pain in Louisiana. The way rates went up, sitting from our side, people were getting gargantuan price increases because they needed it from our side because we're buying the reinsurance and paying for that reinsurance, not because we're somehow soaking up profits, because we needed to take the rate. And people were retaining. They weren't going anywhere else because there's nowhere else to go. So I have a lot of empathy for those customers and our agents. We had a lot of difficult conversations. Like, seriously, my price is going up 50%. This is crazy. I can't afford 50% more. It's like, don't know what to tell you. That's what the market is. So it's good news for consumers. And I like to be able to say that. I like that for our customers, but it creates volatility. And it worries me. We're a little bit of volatility away from prices going back up again. So that makes me a little nervous. I guess it's my job to be nervous in this space. We do write cat exposed property. It's part of it, but it does seem a little bit overdone.
But still, theoretically, are you happy with where the adequacy is? It looks like it should be still technically profitable. Of course, we're talking about cat. Obviously, it's not profitable any 1 year, but at these prices, it should be rate adequate, shouldn't it? Still, even though, of course, the worrying thing is momentum is going to be continuing because the surplus capital is still there.
Yes, reinsurance prices should be adequate for, let's call it a lower capital return expectation of investors. A lot of the capital that's coming into the space, let's say the ILS space, not so much the cat bond space, but the ILS space is expecting higher returns. And I do think many of them are going to say, yeah, we had a good run. And unless we can maintain the returns, it's time for us to exit stage left and redeploy our capital elsewhere. I worry about that capital retreat. I don't think we're going to see that on the traditional side. On traditional reinsurance side, it does appear that their returns are still adequate. But after the pain of the last few years, it's not like they're due, but I guess I wish they would be a little bit higher than adequate for a longer period. Not to pay them back, but to keep the balance there so that they want to keep their capacity in the game. And so it's natural for investors to say, all right, well, this was good. We had a good run, but at these prices, maybe my capital should go elsewhere. That's not healthy. Then we don't want that in the space. I don't want to go through another 2022, 2023 again.
The worry is that this price momentum keeps going downwards because all things being equal, that looks like the way it's going to be. Of course, we look at these wonderful 1/1 renewal reports from all the big brokers, but they're only a snapshot. They're a snapshot of a moment in time at 1/1. the market is actually always moving, and the market is currently moving downwards from here. So again, that would be your warning that we don't want to hit the floor too quickly.
That's right.
Don't give it all back too quickly.
That's right. I hope there's some underwriting discipline maintained in the marketplace. Of course, I don't want that on my programs when we're placing it in the market. But if I'm being objective about the marketplace health, this does feel like the rate of price decline feels too high.
Yeah. And again, I suppose, well, when you're a sophisticated underwriter, buyer of reinsurance, we all know when it's being sold to you at the wrong price. We also know that it can't be sold to you at the wrong price for too long. It's just not sustainable. And actually, do I really want to buy from someone who doesn't necessarily know what they're doing? Or I don't think they know what they're doing. We've all been there before. I know it's difficult because they've got a good rating. They've got their money is good at the moment, but I know in 3 years' time, they won't be here because they won't like what they've just done, because they'll realize that what they've done was at the wrong price. But that's too late for me because I'm kind of having to replace that capital.
Yeah.
It sounds like you'd rather have a partner who had a clear view of risk that coincided with your own, and you could both agree on where you were, and you could know that they would always be there at the right price, rather than having to keep going from feast to famine all the time.
Yeah, for sure. We'd rather have partners like that. The struggle is we have to take advantage of price decreases, or
Yes.
we can't stay competitive in the marketplace. So you got to balance that, your long-term partnerships and what they do with you, with the realities of the marketplace. And that's quite the balancing act that we all have to strike over time. But yeah, all else equal, you'd rather be with those smart partners with long track records who you know are going to be there for you over the cycles. The other challenge of it is we don't know with certainty that it isn't going to be 10 years. I mean, the 2006 through 2015 period was a period where all we saw was Sandy, Irene, and Isaac and Ike, but not much else. And so you could have a period of relatively benign activity, and you say, well, price is going to keep going down. So I don't know. I can't predict the future. I'm not sure how this is going to go. And so it does feel a little overdone, but maybe somebody's got a crystal ball that I don't have.
I'm sure Mother Nature will keep us more busy. It just seems inevitable, or at least keep us busy in different ways as well. Obviously, this time last year, we'd be talking about LA wildfires that we wouldn't have expected necessarily.
That's right.
Let's talk about technology. You've invested a lot in technology and a lot in your own kind of smarts, and obviously you've got that relationship with software. Where are you seeing the best returns on that investment? Particularly, we're now in a maturing phase of our AI investments. We can't just say, hey, we've just been experimenting with it. We know everyone's been experimenting with it for the last 2 or 3 years. Where are you getting the best results?
Great question. So historically, we would always have led with what we referred to as the market leading buying experience. Our view in this business is that you must have bespoke acquisition strategies to win and get your insurance agents who are acquiring the business the best solutions for them to reduce friction. We are an underwriter. We are difficult from an underwriting perspective. It is the reason for our success, the primary reason, and it is the biggest challenge that we have in business because it creates a lot of friction. So we have to create a buying experience. And where our biggest investments are going today are on what we refer to as the post-bind underwriting experience, where we underwrite the business. So we inspect 100% of our properties. So if somebody physically goes out, often with drones, getting images of the house, having them run through a technology platform and speaking to the agents and the customers about underwriting conditions, liability conditions, conditions of the roof, trees, all the things that can end up being hazards. We have a big machine. Hundreds of thousands of risks are inspected a year and go through that machine. And we have to look at all of them in some way, whether it's with the machine or otherwise. So right now, the biggest returns on investment in AI for us are in that process.
Yeah.
We are not convinced that any vendor out there today has a solution that can replace, meaning with AI or aerial imagery that's off the shelf without a physical inspection, can replace what we do on an underwriting side. So we're not moving that direction. Instead, we're using AI and we're using technology more generally to make those processes better across all of our inspection vendors that we utilize. The other area of interest is claims. We are not using AI to settle claim in any way, shape, or form ever. We are using AI to make the process better and faster so that our humans can be more productive. Our humans can spend time where we need humans. And we do not believe that AI is ready to settle a claim soup to nuts at this point. So the answer today is on the post-bind underwriting side and on the claim side. And we believe there's tons more to come there. And then I guess I would say as a minor point on service, as everybody is doing, there are massive opportunities to use AI to make service less expensive and a better experience for our customers. And we are doing that as most or all people are.
And you're feeling, as a boss, you're feeling you're getting good returns on all of those, and you want to be reinvesting in all the time on these. These are really working.
Absolutely.
Terry, you're an amazing entrepreneur. It's a fantastic story that you've had, kind of marching towards the risk when most people were marching the opposite direction. That is a classic entrepreneurial story, particularly in insurance as well in that context. But what kind of entrepreneur are you? You're quite a long way into this journey now. There are two different types that I tend to interview on this show. Somebody who likes to solve problems, who's a sort of serial problem solver, and then they would never really see themselves as an operations person. They say, once I've kind of had this vision, I've built this thing that's here to solve a problem, it works, but I'm not one to sort of optimize it and squeeze the best returns out of it forever and a day. And I'll move on to the next problem because I'll find something really interesting, and there's never a shortage of new problems to solve. Or there are the others who will build something and want to stay with it, and this will be their legacy. This will be the thing they hand down to their grandchildren, that kind of thing. So what kind are you?
Yeah, you probably already know the answer to that question. I'm a long distance runner. I'm going to grind it out. I'm going to keep going at it, keep running the circles around the track. I have no intention of moving on from this. I love what I'm doing. I have no desire to sell. If I was going to sell, I probably would have sold a while ago. I mean, I guess people can have epiphany or life-changing events. My joke is that my midlife crisis is buying a bicycle that's more expensive than my car. So I'm a grinding out long distance person. So we're going to stick at it here. I'm going to stick at it here.
Yeah, well, now you've got an expensive bike. I know you understand all the kind of, what was it? I'm trying to remember his name, the famous British cycle team, GB cycle team guy, 1% marginal eking out of incremental gains. Just tiny little tweaks here and there, and just constantly, for the guy winning the Tour de France and winning all the Olympic velodrome medals.
That's our business. That's our business. We're going to eke it out the 1%. So I think that's actually a good metaphor for how I think about our business. At this point, the business is working pretty well. There's a lot of 1% gains to continue to get in the business. AI certainly helps with that, but by no means is that the only way we're thinking about that. The 1% gains happen in data quality. The 1% gains happen in how we underwrite. The 1% gains happen in how we distribute, how we think about distribution. They exist in how we convince our global reinsurance partners that we are, in fact, a better provider of data, a better underwriter of the risk, a better settler of claims, and eking out those 1% here and there.
I really appreciate that, Terry. Thank you so much for your time. It's been really, really fascinating. I think I'm going to have to book in time in the future to check in on where this story is going because it's moving pretty fast. So thank you so much for your time. It's been really, really enjoyable.
Thanks so much, Mark.
Thank you.
Been great being here. Thanks so much.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.